Welcome to the deep dive. Today, we are taking a granular look at a global giant whose stock performance has recently looked anything but stable, Diageo.
Mm.
We're talking about the world's largest spirits producer, the company behind Johnny Walker, Guinness, Smirnoff. You'll see it listed as DEO or DGE.
And you really couldn't have picked a more tense moment for this analysis. The story of Diageo right now is a masterclass in market panic meeting long-term investment strategy.
Absolutely. The financial backdrop is startling for a company that's famous for its defensive stability and, centuries-old brand heritage.
It really is.
Since its absolute peak in 2022, when shares were trading above £40, the stock has undergone a brutal re-rating, floating recently in the, GBP 18 to GBP 22 range?
Yeah, around there. And that's a reduction of nearly 50%.
A 50% haircut. That stock price collapse has fundamentally altered the investment thesis.
It has. We're looking at a premium valuation, a PE multiple, that once hovered near 30 times earnings, which is, typical for high-growth tech or luxury goods, that has now plummeted to around 17 times.
Right.
For you, the listener, this dramatic shift presents a classic high-stakes question.
And that question, which we've pulled directly from the stack of financial reports and analyst assessments we've reviewed, is our mission today. We have to determine if this historic low valuation represents a genuine value stock opportunity, a rebound play for a patient investor who buys quality on sale, or if it is a classic value trap masking deep, potentially irreversible structural problems that justified this lower multiple.
And we're going to spend a lot of time on that. We'll dissect the accumulation of risks, especially the complex financial decisions management is making around capital expenditure.
Right.
We need to assess whether these issues are merely temporary market swings,
Yeah.
Driven by cyclical inventory corrections, or if they point toward permanent changes in global consumer habits.
Generational health shifts.
Yeah, exactly. Ultimately, we are asking if management's strategy is a heroic long-term gamble or, a near-term disaster just waiting to happen.
Okay, let's unpack this downturn. When a company with Diageo's pedigree sees its valuation halved, it's never just one issue.
Never.
The sources show a confluence of negative factors hitting simultaneously, creating what can only be described as a perfect storm. What are the key risks that analysts have identified?
I think we need to categorize these. You have the immediate cyclical market pressures, and then you have the longer-term structural and regulatory threats.
Okay, let's start with the market pressures.
The first one is simple and really inescapable. It's the unwinding of the post-COVID spirits consumption boom.
That temporary surge when everyone was either making elaborate cocktails at home or flooding back into bars after the lockdowns ended?
Precisely. That wave of demand was just never sustainable, and now it is reversed, leading to declining depletion volume.
Depletion being what's actually sold off the shelf.
Correct. And this impact is felt heavily in on-trade channels, that's your bars, restaurants, clubs, which are highly sensitive to economic slowdowns.
Right. Less discretionary spending.
And even off-trade channels, such as retail and grocery sales, have cooled significantly. The growth trajectory has effectively stalled out.
And we have specific data that proves this isn't just a slight cooling off.
We do. And the long-term data is pretty sobering. If you look at the 5 years from 2019 to 2024, the organic volume compound annual growth rate, or CAGR, was a near 0.8%.
Wow, less than 1%.
And what's critical is that this lackluster result is almost identical to the long-term pre-pandemic average growth rate seen between 2008 and 2021.
So the COVID boom was just a blip. It masked what was already very slow growth.
It totally masked a deeper reality of low baseline volume expansion. So any investor who bought in 2022 betting on that hypergrowth continuing was essentially investing in a temporary distortion, not a new accelerated trend.
Okay, that makes sense.
The current volume declines really echo moments of deep economic strain in the past, like the 2009 global financial crisis or the emerging market weakness around 2014-2015. It suggests this is a harsh return to reality.
And layered on top of that volume issue is the notorious inventory glut. This is the second and maybe the most acute headwind, especially in their most profitable market, the U.S.
This is a mechanical problem in the supply chain. During the boom, producers, Diageo included, they just ramped up production and aggressively shipped stock to distributors and retailers.
Right.
The distributors, fearing future shortages, they took all that inventory. So now the supply chain is just completely oversaturated. We have a severe case of excess channel inventory.
So what's the dynamic now?
The crucial dynamic now is that retailers must ensure their depletion, the rate at which consumers actually buy the bottles off the shelf, is significantly higher than the shipment rate, the deliveries they take from Diageo.
Meaning they have to run down all the existing stock on their shelves and in their warehouses before they even think about placing new orders.
Exactly. And that translates directly into a painful and immediate drop in Diageo's reported sales volume, particularly in North America, which is their crown jewel market.
And that destocking process is painful and takes time.
A lot of time. And compounding that is the third factor, consumer downtrading.
The pressure on the consumer's budget.
Precisely. Weak consumer sentiment acts as a hard limit on Diageo's ability to use pricing power, which is something they rely on heavily.
This must be particularly damaging for them given their focus on the high end of the market.
It is. Their whole strategy is deliberately skewed toward the premium and ultra-premium segments. The sources clearly highlight that as inflation and economic anxiety persist, consumers are trading down, swapping their preferred high-end scotch for cheaper alternatives.
And that hits Diageo's margins directly.
Right in the margins.
And while those three are broad pressures, the fourth one, Latin American weakness, was a specific event that really triggered the alarm bells, wasn't it?
It was the catalyst. It triggered the late 2023 profit warning that dramatically accelerated the stock's decline.
Okay.
The Latin America and Caribbean markets, or LAC, have seen a sales decline exceeding 20%.
20%.
And this wasn't just soft demand. It was a disastrous combination of widespread inflation, crippling consumer budgets, poor internal inventory forecasting by Diageo in that region, and aggressive downtrading.
So it exposed internal weaknesses, not just external market stress.
It really did.
Okay, those are the immediate financial hits. Let's pivot now to the external, potentially existential pressures, the health and regulatory risks that could fundamentally redefine the entire spirits industry.
Right, because these threats introduce the element of genuine structural long-term risk. First, let's talk about the GLP-1 impact.
The new generation of weight loss and diabetes treatments, like Ozempic?
Exactly. Early studies and anecdotal evidence suggest that the increased adoption of these GLP-1 agonists reduces cravings for all addictive substances, including alcohol.
That's a biological headwind that is completely outside of Diageo's control.
Completely. If millions of consumers just experience a reduced desire or capacity to consume alcohol, it could be a structural limiter on volume growth for decades to come.
That is a fascinating and, for a beverage company, a terrifying thought. A biological shift replacing marketing efforts.
Then you have the explicit health warnings. The recent statement by the U.S. Surgeon General, which explicitly warned of a clear link between alcohol consumption and cancer, is momentous.
Right.
It instantly raises the specter of increased regulatory scrutiny across the whole industry, potentially mirroring what the tobacco industry faced decades ago.
So things like plain packaging, higher taxes, restricted advertising.
All of it. This kind of official warning has the power to fundamentally shift cultural consumption habits away from spirits long term.
And moving from health concerns to trade risk, the potential for new U.S. tariffs looms large, threatening their entire import strategy.
This is a quantifiable financial catastrophe just waiting to happen. The threat involves potential high tariffs, say 200% on EU imports, or new tariffs on Canadian or Mexican imports.
And this isn't some distant possibility. It's a near-term political risk.
And it is vital for Diageo, because roughly 40% of its U.S. revenue relies on imported brands like Canadian whiskey, so Crown Royal, and Mexican tequila like Don Julio and Casamigos.
If these tariffs are imposed, we know the immediate financial hit would be massive.
Yes. Analysts estimate that if these tariffs were fully applied, it would translate to an immediate $200 million annual hit on operating profit.
Wow, and that's before they could implement any mitigating strategies.
Before anything. Before they could absorb the cost, raise prices, or try to reroute their supply chain. It's a risk that has to be priced into the stock today.
And finally, let's wrap this section with the internal financial pressure, Diageo's rising debt load, or gearing ratio.
Right. Diageo traditionally targets a leverage ratio of 2.5 to 3.0 times net debt to EBITDA.
And where are they now?
They are currently at 3 times. And because profit is declining from all the headwinds we've listed, and they still have a high cash demands for CapEx and working capital, that ratio is climbing toward 3.3 times.
Wait a minute. If they climb above that 3.0 or 3.3 times level, are there specific financial consequences? What happens then?
There are 2 main implications you need to be aware of. First, credit rating agencies like S&P or Moody's look very closely at that 3.0x level. Sustained leverage above this point can risk a credit rating downgrade.
Which would raise Diageo's cost of borrowing?
Exactly. And second, and maybe more urgently, large corporations often have specific loan covenants with banks that stipulate maximum leverage levels. Breaching a covenant usually results in higher interest rates, fees, or even early repayment demands.
In a high interest rate environment, that's a serious drag on cash flow.
It's a massive drag and a huge limit on the company's flexibility. And this pressure is central to the debate over the sustainability of their dividend, which we'll get into later.
Okay, so now we arrive at the core intellectual debate for any investor looking at this. We've cataloged the risks. Now we need to decide, are these risks temporary and cyclical, meaning they'll reverse as inventory normalizes? Or are they permanent and structural, signaling a long-term contraction in demand for spirits?
This distinction is everything. It's what separates a buying opportunity from a classic value trap. Let's break down the cyclical view first.
Okay.
This argument is powerful because it addresses the immediate market chaos we just described.
The post-COVID hangover and the inventory overshoot.
Precisely. The cyclical camp argues the sales decreases are solely due to that sharp reversal of the post-COVID boom, coupled with an industry-wide inventory overshoot. All the producers, Diageo, Pernod Ricard, Brown-Forman, they all made the same mistake of overshipping product.
So the channels are just flooded with stock. It's a physics problem, not a consumption problem.
Exactly. So if the cyclical view is correct, the solution is already baked into the system.
How so?
The underlying principle is that consumer demand, or depletion, remains relatively stable, maybe sees modest growth, but the shipments from Diageo have to slow dramatically until the channel absorbs all that excess.
Right.
Once inventory levels normalize, and analysts think that could take another 12 to 18 months in the U.S., shipments will stabilize and growth will mechanically resume. This correction is temporary, limited to a 2 or 3 year window.
Okay, that's the optimistic case. Now, let's pivot to the structural view. What's the evidence that suggests this decline is permanent, that we're seeing a fundamental shift away from alcohol?
The structural view points directly to the increasing public awareness of health and that seismic generational shift in consumption habits.
Right. Gen Z drinking less.
Exactly. We mentioned the Surgeon General warnings, but the long-term trend is that younger generations, particularly Gen Z, are demonstrably prioritizing wellness and sobriety. They're just consuming less than millennials or Gen X did at the same age. If that trend holds, Diageo's volume market isn't just fluctuating, it's slowly shrinking.
That sounds dire. But this is where Diageo's entire business model kicks in, right? The premiumization thesis? This is their counter-argument.
This is the essential bull case. The thesis is that if people are drinking less, they will drink less but drink better, meaning they opt for quality, heritage, superior ingredients when they do consume alcohol. And if that holds true, Diageo, which owns those aspirational brands like Don Julio and Johnnie Walker Blue Label, can maintain or even grow revenue and margin per unit, even if the overall volume shrinks.
So does the data actually support this premiumization defense?
Critically, yes it does, though with some recent headwinds. Historically, the trend is undeniable. In developed markets, Diageo's premium and super premium tiers jumped from 53% of sales in 2017 to 71%.
Wow, that's a massive shift.
It is. It suggests a very successful move upmarket. So even if volume falls structurally, the revenue and margin per unit can continue to expand, provided they successfully convince consumers to move from, say, a standard $30 spirit to a $50 ultra-premium selection.
So their strategy is essentially betting on the consumer psychology that if you're going to cheat on your wellness diet, you'll splurge on the best product.
That's it exactly. They are betting on the trading up thesis, surviving a trading down headwinds currently caused by inflation.
And we have to acknowledge the U.S. data here.
Yes, the National Institute of Alcohol Abuse and Alcoholism, the NIAAA, found that per capita, alcohol consumption plateaued in 2022 after 3 decades of increase.
So the post-COVID spike ended, but it's not a definitive structural contraction yet.
Not yet. For 3 decades, American consumers were moving consistently from beer and wine to spirits. The big question is, has that 3-decade secular growth trend for spirits finally ended? Or is this just normalization after a chaotic few years?
Okay. Let's move to a related and far more technical problem that supports the value trap argument, the low-free cash-low conversion puzzle. For a consumer staples giant, Diageo's cash generation is surprisingly weak. Why are they struggling to turn reported profit into actual usable cash?
This is perhaps the most fundamental operational flaw identified by the analysts. High-quality consumer staples, think major food or personal care companies, They operate with asset-light models and typically convert 90 to 100% of their net profit into FCF. Diageo historically ran lower, but recently their conversion rate has been poor, sinking to levels we last saw during the deep stress of the 2012-2014 European sovereign debt crisis.
So if they're reporting good profit on paper, why is the actual cash disappearing? Where is the friction?
The cash is being heavily consumed by two distinct elements of their capital allocation strategy: high capex intensity and massive net working capital investment, specifically the investment in maturing stock.
Okay, let's define high capex intensity first.
CapEx intensity refers to the amount of capital expenditure money spent on physical assets like distilleries, equipment, warehouses relative to the depreciation and amortization or D&A expense.
Right.
A healthy, mature company often sees CapEx roughly equal to D&A. Diageo is spending 1 to 2 times its D&A expense.
So they're aggressively building new capacity and refurbishing existing assets much faster than their existing assets are wearing out.
Much faster. It's a massive cash sink. They are choosing to invest capital aggressively today for capacity that won't be fully utilized or maybe even needed for years.
That is a huge drag on cash.
It is. Their CapEx as a percentage of sales has risen aggressively from around 5% in 2016 to a projected 8% in 2025. That is the #1 drag on FCF.
And the second culprit?
The second is the net working capital investment, which is dominated by maturing stock. This is the liquid whiskey, tequila, rum that has to age for years or even decades before it can be sold.
So every time they fill a new barrel of whiskey, that's cash tied up that won't generate any revenue for years.
Precisely. Unlike standard inventory, which moves quickly, maturing stock represents massive amounts of non-revenue generating cash tied up, sometimes for 15 years or more. And both the elevated CapEx and this massive investment in maturing stock are conscious management decisions.
And that's the core of the controversy.
That's it. They're prioritizing long-term, distant future capacity over immediate cash flow generation and debt reduction. So the low valuation today is less about the state of the consumer and more about whether investors trust management's vision for the next decade, given this near-term cash drain.
Right. And this brings us to the core conflict. Why are they demanding so much capital for CapEx and maturing stock, despite weak consumer sentiment, rising debt, and low FCF conversion?
It's the key question.
Let's start with the skeptic's interpretation, the worst-case scenario. If you're bearish on management, how do you interpret this aggressive, cash-intensive spending?
The bearish view centers on managerial misjudgment and misaligned incentives. First, there's the possibility of just pure overconfidence.
Okay.
Management may have grossly overestimated the sustainability of demand during that post-COVID supercycle. Now that demand is stalled, they face a dilemma.
Do they admit the mistake?
Right. Admitting the mistake means canceling expensive CapEx projects, incurring significant cancellation costs, and potentially triggering layoffs or restructures. So they press ahead to save face and justify the initial projections.
Okay, so that's one theory.
Second, critics argue that the increased investment in maturing stock might function as a form of, well, accounting manipulation.
How so?
If market demand has stalled, the company is producing excess liquid. Management could bottle that excess as finished product, but then it would immediately become slow-moving finished goods inventory.
Which would hit their performance metrics.
It would hit the operating cash conversion calculation directly and negatively, but by classifying it as maturing stock.
It allows them to tie up the cash without an immediate performance penalty.
Exactly. And this leads us to the most critical analysis point: the flaw in their annual incentive plan, or AIP.
The bonus structure.
Right. Diageo's incentive structure is primarily linked to top-line and bottom-line growth.
Oh.
Crucially, the AIP calculation for operating cash conversion explicitly excludes maturing stock investment.
That's a massive finding from the sources. So if the incentive calculation excludes the cash drain from maturing stock, management is directly incentivized to pump more cash into barrels today.
Yes.
Because they don't get penalized for the associated cash consumption until years later when the stock is eventually sold.
It creates a clear misalignment. Management is encouraged to maintain aggressive production schedules, converting excess liquid into a long-term asset that doesn't immediately hurt their annual bonus targets, rather than being incentivized to prioritize immediate cash flow or deleveraging.
This structural flaw strongly supports the value trap argument. It suggests leadership is prioritizing vanity projects and compensation targets over shareholder capital efficiency.
It does.
Okay, that is a compelling case for the skeptics. Now let's hear management's defense, the best case scenario. CEO Debrecru and the executive team insist the spending is necessary. What is their core rationale?
Management views this spending as necessary investment in long-term growth enablers. They argue that spirits is a long-horizon business. Their investment decisions are based on volume growth projections stretching out 10 to 20 years, driven by three major secular trends.
Which are?
Continued global population growth, the ongoing shift of consumers in emerging markets from beer and local spirits toward international spirits, and overall GDP and earnings increases in those emerging markets.
So they are essentially looking past the current inventory cycle and betting on the long game. What specific rationale drives the huge maturing stock investment?
It's largely about correcting for past underinvestment and capitalizing on that premiumization trend. They're catching up on depleted reserves of high-quality scotch after the COVID supercycle ate into their aged reserves.
Okay.
And in tequila, acceleration of aged liquids is necessary because aged tequila reposado now makes up 30% of that market, which requires more cash tied up in barrels.
So their argument is if we don't produce today, we will have nothing to sell in 10 or 15 years.
Exactly. They'd lose massive market share to competitors who did invest.
And what specific CapEx projects are eating up all the cash?
The spending falls into two buckets. The first is capacity expansion driven by current high-growth success stories. The premier example is building a second Guinness brewery in Ireland.
Why?
This is necessary to keep pace with the phenomenal growth of Guinness 0.0, which is an extremely high-growth, high-margin category.
Got it. And the second bucket?
The second bucket is pure long-term market access. The construction of a new single malt whiskey distillery in Yunnan, China.
Wow.
Management is candid about this. The benefits of this investment won't be seen for many, many years, but it's a necessary strategic entry point into the massive Asian consumer base.
That is aggressive. Has management shown any willingness to scale back the spending, given all the market pressures?
They have. They've confirmed they're reviewing all capital expenditure and applying stricter IRR and payback metrics. We have seen some moderation. For instance, they paused construction of a CAD $245 million distillery in Canada.
Right, for Crown Royal.
Yes, signaling they recognize the oversupply. However, they are prioritizing others, like a new USD $415 million facility in Alabama to enhance the North American supply chain.
So even with the review?
Even with the review, they have guided that CapEx will remain elevated until at least fiscal year 2027. This means the cash flow drag is locked in for the next 3 years.
Now let's address the true elephant in the room for the value trap thesis. The dividend dilemma. Diageo maintains an enormous dividend payout while carrying high debt and aggressive CapEx plans. How can they justify this?
This is where the strategy becomes most controversial. You have analysts openly suggesting management is borrowing money to pay dividends.
Wow.
Diageo annually spends about $2.3 billion on dividends. The dividend payout ratio averages an unsustainable 85% of FCF.
So almost every dollar of free cash generated is immediately returned to shareholders.
It is. So if they are simultaneously spending massive amounts on CapEx and maturing stock and returning 85% of their FCF to shareholders, that mathematically explains why their debt is rising above 3 times. They have no internal cash buffer left.
That's the core accusation.
With leverage over 3x, the need to deleverage is paramount. Diageo has committed to returning to its target leverage range of 2.5x to 3.0x by the end of fiscal year 2028.
Okay.
But to achieve this while maintaining current CapEx and dividend levels, analysts calculate they need to reduce their debt profile by approximately $8 billion over the next 3 to 4 years.
$8 billion in debt reduction while cash flow generation is weak and CapEx is elevated until 2027. That sounds mathematically impossible without a huge and currently unforecasted surge in operational cash flow.
It creates a massive financial squeeze. Management points to the Accelerate restructuring program, targeting $625 million in cost savings, and some asset disposals, but the numbers are highly skeptical.
So the fear is?
The fear is that management will be unable to hit both the deleveraging target and maintain the current dividend. This inability raises the very real possibility of a future dividend cut.
And for a defensive, long-term growth stock, a dividend cut would send a massive negative signal to the market.
It would confirm the depth of their financial distress.
Okay, let's ground this intense debate in the most recent data we have. After outlining management's aggressive long-term strategy, the critical test of their optimism came in the recent Q1 fiscal 26 results. How did the company actually perform? Did that consumer downtrading and inventory glut stabilize?
The results were messy, and they really confirmed the market tension. Overall, organic net sales were dead flat, 0.0%.
The zero.
But that flatness wasn't stability. It was a perfect cancellation act. You had positive organic volume growth of 2.9%,
Which sounds good.
but is entirely offset by a negative price mix of 2.8%.
Okay, let's fully dissect that negative price mix drag of 2.8%. So volume was up, but they made less revenue per bottle. What caused that severe mix erosion?
Negative price mix means one of two things. Either they are cutting prices, which is less likely for Diageo, or consumers are shifting their purchases toward cheaper products within the portfolio.
Or toward regions that sell lower-priced products.
Exactly. In this case, the drag was almost entirely due to adverse mix in Asia-Pacific, driven by weakness in Chinese white spirits, or CWS.
What happened specifically in CWS?
Reduced consumption occasions, partially linked to local market policies impacting social gatherings and gifting, caused a severe decline in that segment.
And what was the impact on the total company?
Analysts estimate this CWS weakness alone negatively impacted group net sales by approximately 2.5% in the quarter. Furthermore, the weakness in North America, with consumer downtrading, meant fewer sales of their highest margin super premium items.
So looking regionally, where was the resilience? Who were the winners offsetting North America and Asia Pacific?
There were pockets of surprising resilience, actually. Europe showed solid organic net sales growth of 3.5%, driven by key brands like Guinness.
Okay.
Latin America and the Caribbean, surprisingly, rebounded with 10.9% growth, which suggests the inventory correction and inflation headwinds there may be easing faster than feared.
And Africa?
Africa also demonstrated strong growth at 8.9%.
So the regional drag was primarily North America and Asia Pacific, right?
Correct. North America was down 2.7%, struggling against a combination of a softer consumer, more competition in tequila, and just lapping tough comparables from the prior year's aggressive restocking of Don Julio.
And Asia Pacific was the clear laggard.
Down 7.5%, driven by those CWS issues in China.
Okay. Despite the flat overall results, the company has some incredible individual brand successes that feed the bull case. What specific growth pockets are highlighted that validate management's long-term CapEx strategy?
First, you have to talk about Guinness. It continues its sustained phenomenal momentum globally. The growth is fueled both by traditional Guinness Draught and, critically, by the successful rollout of Guinness 0.0. The growth rate of the non-alcoholic segment justifies the necessity of building that second massive brewery in Ireland.
And what about their core high-margin spirits portfolio?
Scotch, particularly Johnny Walker, showed good global growth. It was especially strong in emerging markets like Brazil, Turkey, and the Middle East North Africa region.
So that demonstrates that their heritage brands still have that aspirational status and pricing power when consumers in these markets trade up.
Exactly.
Ready-to-drink categories also seem to be a high-growth area.
Absolutely. RTDs and ready-to-serve cocktails are riding a massive convenience trend. We're seeing strong momentum in products like Smirnoff Ice, their branded cocktail collections with Bullet and Ketel One, and the newly launched Casamigos RTD line.
And those have good margins.
Excellent margins and fast scaling potential because they don't require the aging time of traditional spirits.
And finally, tequila remains the long-term engine.
Tequila is critical. It's been the fastest growing hard alcohol category for the last decade. And Diageo is incredibly well positioned with Don Julio and Casamigos.
Right.
So even though North American tequila declined sharply in Q1 F26 due to those difficult comparables, the long-term global shift toward premium agave spirits remains firmly intact. Management's heavy investment in aging tequila is a direct bet on this sustained global trend.
Zooming out, what are the macro, long-term market tailwinds that could drive a significant re-rating of the stock, assuming they execute flawlessly?
The single most potent future tailwind is the Indian market.
India.
Management views India as a game changer. By 2030, a quarter of the estimated 600 million new legally aged drinkers worldwide will come from India.
A quarter? Wow.
And spirits consumption per capita typically grows dynamically with per capita GDP growth. And India is a vast, historically whiskey drinking market that aligns perfectly with Diageo's strongest brands.
A multi-decade opportunity.
That could dramatically outweigh short-term U.S. inventory cycles.
And a second, more near-term driver.
It's simply the resumption of growth in the critical U.S. market and the normalization of inventory levels. Once the cyclical destocking ends, the volume numbers should immediately rebound, stabilize the business, and silence the value trap arguments.
And internally, the Accelerate program aims to provide immediate relief to the margins.
Right, the Accelerate program is on track to deliver $625 million in cost savings over 3 years. And this isn't just basic cost cutting. Management is using AI and advanced data analytics to drive efficiencies in everything from logistics to marketing spend.
Okay.
Successful execution here is necessary to protect margins during this downtrading phase. So, to synthesize this entire debate, the stock recovery is not guaranteed. It depends on a cluster of 5 critical triggers materializing simultaneously, or at least in sequence. If you're contemplating buying Diageo today, you are betting on these 5 conditions being met.
Okay, what's the first one?
First, you need the profitable U.S. market growth to resume, signifying the end of the destocking cycle.
Second, we need CapEx intensity to normalize, which management has tentatively guided for around 2027.
Third, there must be a definitive reduction of net working capital investment. That means management needs to ease off on that cash-consuming, maturing stock production, maybe by signaling a willingness to reduce those AIP targets.
Fourth, the U.S. tariff threat has to be resolved to remove that $200 million operating profit risk.
And finally, number 5, you need successful execution of the Accelerate program, delivering the targeted cash flow improvement necessary for them to deleverage by FY28.
That's a lot of dominoes that have to fall just right. And if you wait for all 5 to fall, you will undoubtedly miss the re-rating.
You will.
This brings us to the conflicting analyst views. At the current price, around 17 times pre-tax earnings, the experts are fundamentally divided on whether this is the bottom.
Let's look at the bull case, the perspective of the long-term holder, exemplified by the analyst Matthias. The belief here is in the untouchable quality of the assets. The brands. Diageo possesses durable, world-class, multi-century brands. Johnnie Walker, Guinness, Smirnoff, Tanqueray. They have tremendous scale, superior global distribution, superior marketing spend.
And the ability to age inventory longer than any startup could dream of.
Exactly. So Matthias' argument is that the company has such a high floor, built on centuries of heritage, that it will inevitably survive these temporary market disruptions.
And he projects a long-term potential of around 10%.
And that's right. Broken down into 2 to 3% volume growth, 2 to 3% pricing mix uplift via premiumization, and steady margins supported by cost savings. For Matthias, the current price represents a strong entry point into an empire that is temporarily facing external non-structural pain.
Okay, now what about the bear case, the value trap warning? Why did analyst Luke choose to sell his entire position when the stock was already down so significantly?
Luke's skepticism focuses entirely on management's capital allocation and the structural dependency on emerging markets.
Right.
Luke argued that the risk-reward ratio at 17x earnings was not compelling enough, especially when you consider the debt profile and the controversial strategy of borrowing money to pay the dividend.
So his view is that even modest long-term growth isn't guaranteed.
Not at all. His view is that if the negative volume trends prove even marginally structural, say, if Gen Z never returns to the consumption levels of prior generations, then even a modest 3% long-term growth is not a given.
And he specifically noted that a PE of 16 or 17 times is still expensive if the long-term earnings potential is permanently impaired.
Exactly. Luke's thesis, which is echoed by other extreme bears, is that given the looming health and regulatory risks, the GLP-1 impact, the cancer warnings Diageo is starting to look less like a defensive consumer staple and more like a company facing the kind of long-term pressure once seen in the tobacco industry.
And those analysts suggest waiting for tobacco multiples.
Yeah, high single-digit PE ratios to provide a sufficient margin of safety against that potential structural decline.
So if we look at the current valuation reality check, what's the consensus position right now for our listener?
The analyst consensus is that current prices are fairly priced if you strongly believe the market will recover and management will deliver on their CapEx normalization timeline.
So if you take the cyclical view.
Right. If you bet on U.S. normalization and CapEx coming down post-2027, 17 times is acceptable. However, the price is potentially expensive if you believe the structural risks are real. The sources suggest that a lower entry price, specifically below £15 per share, would provide a much better risk-reward ratio.
Okay, that brings us to our final synthesis. Diageo is wrestling with a profound internal contradiction right now. It is simultaneously investing aggressively in its long-term future, pouring billions into CapEx and maturing stock, while battling severe short-term headwinds. It's a conflict between optimizing for the next decade and just surviving the next 2 years without compromising its financial integrity.
And that conflict fundamentally boils down to the question of management accountability and incentives. Since Diageo's aggressive future relies entirely on their capital allocation paying off years down the road, and because their current compensation structure doesn't penalize them for excessive short-term cash consumption, you have to watch the leverage ratio and the dividend policy.
Right.
How long can the board and shareholders truly tolerate near-term earnings drag and leverage climbing above 3 times before they are forced to demand a fundamental shift in priorities?
A very good question.
And if management is compelled to cut CapEx, or more critically, pause or cut the $2.3 billion dividend, what would that signal about their true conviction in their long-term volume growth projections? That impending choice debt reduction versus dividend sustainability is the signal that will determine whether Diageo is a value stock or a value trap.